everybody, Chris here from Project Option, and in this first option strategy video, we're going to talk about the bullish strategy of buying call options. So let's get right into it. Okay, so buying calls, also known as being long calls in some instances, is a strategy that consists of buying a call option on a stock that a trader believes will increase in price. So buying call options is a very bullish strategy. Now, when you're buying call options, the maximum profit potential is unlimited because there's really no limit for how much a stock price can increase. Now, in regards to loss potential, the most you can lose when buying a call option is the premium that you pay for that option. So the worst case scenario when you buy any option is that the option expires worthless, in which case you lose the premium that you pay. So the expiration break-even price when buying a call option is the call option strike price that you purchase plus the premium that you pay for that call. So for instance, if you buy a call option with a strike price of 100 and you pay $3 for that option, the expiration break-even price was $103. Now the estimated probability of profit when buying a call option is theoretically less than 50%. Now that's because when you buy a call option, your break-even price will often be a little bit more, if not significantly more, than the current stock price. So what that means is that you need the stock price to increase by a certain amount just to break even. And for that reason, buying call options is a lower probability trade. Now, if the call option is in the money at expiration, each call option will expire to 100 shares of long stock. So if you own a call option at the strike price of 100 and the stock price is greater than 100 at expiration, you'll effectively buy 100 shares of stock at $100 per share if you let that option expire in the money. Now, in regards to assignment risk, there is no assignment risk because the only time you can get assigned is if you're short an option. So when you buy an option, you're the one that has all the control over exercising, and therefore, when you buy a call option, you have no worries about getting assigned. So now that you know the basic strategy characteristics of buying call options, let's go ahead and look at a hypothetical long call trade and then examine its expiration risk profile. So here we're looking at a hypothetical option chain. So we're looking at various call strike prices and the call price. So let's say at the time of these option prices, let's say the stock price is currently trading for $100 and we think the stock price is going to increase. So we're going to buy the call option with a strike price of 100 and we're going to pay a $5 premium for that option. Let's go ahead and take a look at what the expiration risk profile looks like for this position. Okay, so as we can see here, we have a lot of upside potential and we have limited downside potential. So in this case, we're buying the call option with a strike price of 100. So at any price equal to or below 100, this option will expire worthless at expiration, which will result in a net loss of $500. Now that's because we bought the call option for a $5 premium, and that $5 is in option terms. So to convert that option price into an actual dollar amount, we multiply the $5 premium times 100. So the most we can lose is $500 if the stock price is at $100 or below at expiration. Now, as we said before, the break-even price is the strike price plus the premium we pay. So we paid $5 for a call option with a strike price of 100. So 100 plus 5 is 105. So as we can see here, if the stock price is right at 105 at expiration, we're going to break even on this trade because that 100 call option is going to expire with $5 of value. Now at any price above 105, we start to see profits. So for instance, if the stock price is at $115 at expiration, that 100 call option is going to be worth $15. And since we paid $5 for it, we're going to have a profit of $1,000. So that's $15 minus the $5 we paid for it times 100, which gives us the profit of $1,000. Now, as we can see here, the long call strategy has limited loss potential but unlimited profit potential. So in any trading strategy, the relationship between potential profits and potential losses can help you determine what the probability of making money on that trade is. So in this case, since our loss potential is small and our profit potential is large, we have a lower probability of profit. Now, another thing that can help explain the low probability of profit is that we need the stock price to increase by a certain amount just to break even at expiration or make any money. So, to help you understand how a long call strategy makes money through time, we have to look at the Greek exposures. So, let's take a look at a long call options Greek exposures. So, starting with delta. A long call option position has positive delta because as stock prices rise, call option prices rise, which is good for call buyers, and when the stock price falls, call prices also decrease, which is not good for call buyers. So the positive delta means that we want the stock price to increase. Now, a long call option strategy has positive gamma because as the stock price increases, the position delta of the long call is going to increase as well. Now, when you combine the positive delta and positive gamma together, those two things tell you that you want the stock price to increase in an explosive manner. Now, that's because if the stock price increases, you're going to make money from your deltas, but your delta is also going to increase as the stock price increases. Now, if your delta increases, that means for the next 1 point increase in the stock price, you're going to make more and more money than you did for the previous $1 move in the stock price. Now, as we talked about briefly before, call option prices, and all option prices for that matter, decrease as time passes. So a long call position will have negative theta. Now, that negative theta is an indication to you that since the call option's extrinsic value is decaying away as time passes, that call option's price is going to be decreasing, which means all else being equal, if the only thing that happens is the passage of time, you're going to lose money from owning a call option because that extrinsic value that you purchased is withering away. Now, the last thing is a long call option has positive vega, which means that if implied volatility increases, that's an indication that option prices are increasing. And an increase in option prices when you own an option is a good thing. On the other hand, falling implied volatility is an indication that option prices are becoming cheaper and cheaper, which means you're losing money if you own that option. So a long call option position has positive vega. So when you put all four of these Greeks together, we learn that a long call position profits when the stock price and or implied volatility increases enough to offset the losses from the passage of time. Alright, let's move away from theory and let's look at three specific call options that actually trade in the market. So the first example we're going to look at is a long call that suffers from time decay. So we're going to look at an example where a trader buys a call option and the stock price doesn't really go anywhere and they suffer losses from the passage of time. So here's the trade setup. The initial stock price is $105. The initial implied volatility is 30%. We're going to buy the 105 call option that expires in 31 days, and we're going to pay a $3.40 premium for that option. So, as we know, our break-even price is the call strike of 105 plus the $3.40 premium we paid, which gives us a break-even price of 108.40 at expiration. Now, as we know, the profit potential is unlimited, and the maximum loss potential is the amount we paid for the option, which is $3.40, and if we convert that to actual dollar terms, the maximum loss potential is $340. So let's go ahead and take a look at what happens to this call option position as the stock price moves through time. Alright, so as we know, we bought the 105 call option for a $3.40 premium. Now, on the top part of this graph, we're looking at the stock price in relation to the long call strike that we purchased and the break-even price. And on the bottom part of the graph, we're looking at the actual changes in the option's price. So as we can see here, the stock initially jumped from 105 up to right around our break-even price of 108.40. Now, as that stock price increased, the call option's price also increased because, as we just talked about, a call option has positive delta, which means that as the stock price increases, the call option's price should increase as well. Now, unfortunately, that move was short-lived and the stock price came down and kind of just, remained around the long call strike price for the remainder of the trade period. And as we can see, the call's price slowly withered away and eventually expired worthless at expiration because the stock price was below the call's strike price of 105 at the time of expiration. So any trader that bought this call for $3.40 and held it to expiration lost $340. Now, you don't have to hold options to expiration. What if you bought this option and then you sold it after that first move? You could have sold the option when it was worth $4.50 in the open market. So, since you bought it for $3.40, if you sold it for $4.50, you would have locked in $1.10 of profit, which translates to $110 of profit per call contract. So keep in mind that you don't always have to hold options to expiration. You can always get out early to lock in profits or losses. So let's go ahead and take a look at another example of a long call strategy. So in this next example, we're going to look at a long call strategy in relation to the stock price that's a little more volatile this time. So here's the setup. The initial stock price is $201.02. Initial implied volatility is 21%. We're going to buy the 190 call expiring in 46 days, and we're going to pay a $13.38 premium for that option. So since the stock price is at 201 and we're buying the 190 call, we're actually buying an in-the-money call option. So the break-even price of this strategy is the 190 call strike plus the 13.38 debit that we paid, which gives us a break-even price of 203.38. So the stock price in this case only has to rise about $2 for us to reach our break-even price. Now, as always with the long call strategy, the profit potential is unlimited, and the maximum loss potential is the $13.38 premium times 100, which comes out to a maximum loss of $1,338. So let's go ahead and take a look at this option position through time. So on the top part of the graph, again, we're looking at the stock price relative to the call strike price that we purchased and the break-even price of the strategy. So initially, we bought the call when it had, plenty of intrinsic value. Now, intrinsic value is what the option would be worth if the stock price expired at that specific price at expiration. So initially, the call option had over $10 of intrinsic value, but unfortunately, the stock price actually decreased. Now, since a call option has positive delta, the decrease in the stock price results in a lesser and lesser call price. So as we can see here, we purchased the option for $13.38, and unfortunately, it never traded at that price again. And at expiration, the stock price was just above our strike price of 190, so the call option did expire with some intrinsic value. However, the intrinsic value that it expired with was significantly less than the $13.38 that we bought the option for. So the bottom line is that if you buy a call option and the stock price decreases, you're not going to have a great time because that call option has positive delta, and as the stock price decreases, so will the value of your call option. All right, in this last example, we're going to look at a profitable call option purchase. So a profitable call option purchase looks something like you buy a call option and the stock price rises significantly. So here's the setup. The initial stock price is $94.02. The initial implied volatility is 31%. And the call we're going to buy is the 92.5 call that expires in 42 days. We're going to pay a $4.65 premium for that option, which brings our break-even price to $97.15. So that's 92.5 plus the $4.65 premium, which gives us $97.15. As always, the maximum profit potential on this long call trade is unlimited, and the maximum loss potential is that $4.65 premium times 100, which gives us a maximum loss per contract of $465. Now let's go ahead and take a look at how this call option position fares as the stock price changes. All right, so again, in the top part of this graph, we're looking at the changes in the stock price relative to the call strike that we purchased and the break-even price of this long call position. On the bottom part of the graph, we're looking at the call options price relative to the changes in the stock price. So between 42 days and 18 days to expiration, we can see that the stock price is actually increasing, but the call options price is, remaining right around that 465 mark that we bought it for. Now, as we know, call options have positive delta and negative theta. So since the stock price is increasing, you should be making money from that increase in the stock price. But what we're seeing here is the profits being offset by the negative theta of the position. So essentially what I'm saying is the stock price was increasing just enough to offset the losses from theta decay, and therefore the call options price remained relatively flat over that first period. However, between 18 days to expiration and 0 days to expiration, the stock price takes off and basically rallies from $97 up to around $106. So a nice increase there. And as we can see, the options price also increases. Now at expiration, this call option is worth just over $12, and since it was purchased for $4, the value effectively tripled over this period. Now keep in mind, this is a significant stock price increase relative to the expected stock price change over that time period. So this example really just demonstrates that when you buy a call option, you really need a significant increase in the stock price. Otherwise, if the stock price just kind of increases steadily, you could still lose money because those losses from time decay could offset your directional profits. Alright, well that pretty much wraps up this lesson on buying call options. So let's go ahead and recap the summary of main points. So buying calls is a strategy that's used by traders who have a strong bullish outlook for our particular stock. Now I say strong bullish outlook because as we just saw, unless the stock price increases significantly, a long call position is generally going to lose money. Now buying a call option has limited loss potential and unlimited profit potential, but that translates to a lower probability of profit. A trader who buys a call option benefits from increases in the stock price or implied volatility, but is harmed by the decay of the option's extrinsic value as time passes. So the stock price or IV must rise in a short period to offset time decay. And we just saw that in that last example. To close a long call position before expiration, you can just sell the call option at its current price to lock in profits or losses. So if you buy a call option and it's not going your way and you want to get out of that position, you don't have to hold the expiration. You can just sell the call option, be done with it, take your loss, move on. The same is true if the stock price increases and you want to lock in a profit. And lastly, if a trader holds an in-the-money call option through expiration, they'll end up with 100 shares of stock per contract. Thank you so much for watching this video, everybody. I hope you learned a lot about buying call options. And if you found this video informative and if you enjoyed it, please share it with others and don't forget to subscribe to our channel so that you can receive all of our YouTube videos as they come out.